Oil shipments through the Gulf are strained, bond markets are bracing for higher rates, and yet equities are still hovering near record highs. Welcome to vTalkInsight, Equity Pulse Daily for May 25th, 2026, where we unpack how that tension between macro risk and AI-driven profits is shaping today's equity landscape. The macro starting point is an energy shock layered on top of already sticky inflation. Traffic through the Strait of Hormuz remains heavily impaired, with the United States naval blockade reportedly turning away dozens of tankers and leaving a meaningful slice of global oil demand physically unmet. Estimates suggest that if these disruptions persist, the hit to global output could be material, and the damage would come primarily through higher prices rather than collapsing volumes. Markets have become slightly more hopeful that a reopening deal can be struck, and crude has eased off the very recent peaks. Yet risk premia remain embedded because negotiators are still far apart, and Iran is floating ideas like a toll regime that adds legal and geopolitical complexity. Several scenarios on the table see the strait remaining constrained into the summer, driving inventories toward uncomfortable lows and reopening the debate about triple-digit Brent and gasoline prices that could eclipse prior cycle highs. This supply shock is landing in an economy where core prices have already reaccelerated. Shorter-term measures of underlying inflation are now running well above the trailing year pace, and fuel costs are amplifying the pressure, with gasoline and diesel both up well over 50% year-to-date. Because energy and freight contracts reset with a lag, more of that cost is likely to filter into consumer prices over coming months, even as surveys show consumer confidence and long-term inflation expectations deteriorating sharply. Bond markets have responded decisively. United States 30-year yields have pushed above 5%. Long-dated borrowing costs across the United Kingdom and Japan are back near multi-decade highs, and real yields in America have returned close to prior records. Heavy fiscal deficits, with around $500 billion being added each quarter, are adding upward pressure on the curve just as central banks are emphasizing patience rather than renewed easing. Against this backdrop, the Federal Reserve narrative is shifting. Markets are largely pricing out near-term rate cuts and increasingly entertaining the possibility of further hikes if inflation or wage growth accelerate again. The incoming chair, Kevin Warsh, is expected to lean toward balance sheet reduction, less forward guidance, and a willingness to tighten if expectations drift, while current policymakers like Chris Waller signal that hikes remain on the table. That combination keeps policy in a de facto pause, but with a hawkish bias and more scope for volatility around each data print. Even with that macro mix, equity indices are still trading close to all-time highs and volatility measures remain subdued. The credit spreads are tight, and the headline story is 6 straight quarters of double-digit earnings growth alongside generally healthy corporate balance sheets. So far, rising oil prices have been treated as manageable. But if the energy surge resumes and proves persistent, several views flag the risk of a break where risk assets finally reprice to the weaker growth and higher discount rate regime. Part of the resilience reflects profit delivery. Across the S&P 500, companies are still beating expectations, and forward earnings guidance remains constructive enough that valuations, while above long-term averages, are not being viewed as wildly stretched. There is also a growing consensus in parts of the market that, for now, inflation can be absorbed without a major hit to margins, especially for firms with pricing power or structural growth drivers like artificial intelligence. Beneath the surface, though, leadership is narrow. Recent gains have been heavily concentrated in technology and AI-linked names, which now account for up to roughly 40% of the S&P 500 by weight, with more than 2/3 of April's performance coming from AI and memory stocks alone. Discretionary names tell a different story, with only about 40% in sustained uptrends, underscoring how much of the index-level strength rests on a relatively small cluster of growth and infrastructure winners. Geography is another key fault line. United States exposure is being favored over Europe, where recent macro data and surprise indices have slumped toward their weakest readings since 2023. The European Commission has lifted its inflation projections and cut growth forecasts, while bank lending surveys point to tightening credit conditions. European bond yields have drifted lower alongside oil in recent sessions as investors price weaker growth and rising stagflation risk. In emerging markets, strong 1- and 3-year returns in aggregate mask mounting stress in the more vulnerable names, highlighted by renewed pressure on Turkish assets and currency strains in several energy-importing countries tied to the Gulf disruptions. The primary counterweight to macro gloom is still AI-driven earnings. The latest leg of the rally has been powered by strong results from major AI and hardware firms, with investors treating AI-related capex as a durable, multi-year growth engine for both profits and productivity. Adoption by enterprises, which had stalled briefly last year, is now accelerating again. The catch is that clear, measurable productivity gains and return on investment are only starting to appear, leaving some risk that enthusiasm cools if monetization lags the hype. On the hardware side, signals remain robust. AMD forecasts that the AI CPU market can compound at more than 35% annually over the next 5 years. Dell Technologies has surged to new highs on strong server demand, and Texas Instruments has been upgraded on the back of rising need for its power chips in data centers. Qualcomm's expanded deal with Stellantis to roll out Snapdragon-powered digital chassis solutions shows how AI and connectivity are spreading into autos, while defense contractors like Lockheed and REX are scaling munitions capacity in response to geopolitical demand. Ancillary sectors, from industrials supplying cooling and HVAC to utilities and battery storage, are also seeing meaningful tailwinds from the data center build-out. That boom comes with infrastructure and energy challenges. Single hyperscale facilities are being planned that could consume a sizable share of a country's power, and permitting bottlenecks plus grid constraints are emerging as real brakes on expansion. At the same time, AI compute is getting dramatically cheaper at the unit level, with inference costs reported to be roughly 1,000 times lower than a year ago. That combination of cheaper compute and much higher volumes raises the prospect of AI boosting margins for software and services, even as it exerts new upward pressure on electricity demand and, potentially, on energy prices. Capital formation is accelerating around this theme. The anticipated IPOs of SpaceX, OpenAI, and Anthropic are moving faster as they race to secure funding, while sector-focused vehicles like the DROM ETF have amassed around $10 billion in assets in just weeks, and a NASA-branded ETF with significant SpaceX exposure has quickly become the largest space fund. SpaceX itself is expected to list at a lofty multiple of sales, with its filing emphasizing a vast addressable market skewed toward AI infrastructure. Starlink remains the current revenue backbone, but new lines like terrestrial and future orbital data centers require heavy capital and depend on the successful, reusable deployment of the Starship system. Meanwhile, rule changes that speed inclusion of such low-float IPOs into major indices raise questions about concentration, volatility, and how well retail investors are being protected. On the real economy side, earnings from retailers and consumer names underline a K-shaped pattern. Higher-income households continue to spend relatively freely, supporting categories like luxury goods and premium home furnishings, while lower and middle-income consumers are feeling the squeeze from higher fuel and food costs. Rising gasoline prices are being described as a de facto tax that slows activity without necessarily triggering a classic wage price spiral, and market leadership appears to be tilting toward larger, higher-quality growth franchises that can ride out more muted volume growth. Walmart and Kroger are cutting prices to defend market share, which implies near-term margin compression and adds some valuation risk for Walmart, given its premium multiple. Yet Walmart's advertising arm is growing rapidly, with ad revenue up sharply and now representing roughly a quarter of operating income, providing a higher margin offset. Data from Walmart also show average gallons per fuel transaction falling to the lowest levels since 2022, a clear signal of strain among lower-income shoppers. At the same time, warehouse clubs like BJ's are gaining share as both affluent and budget-conscious consumers seek value, while auto parts retailers such as AutoZone and O'Reilly continue to post solid growth as drivers opt to maintain existing vehicles rather than buy new ones. At the top end, luxury remains surprisingly resilient. Williams-Sonoma is outperforming peers despite broader housing softness, and European names like Richemont and Cartier are delivering strong results even as regional macro risks mount. Estée Lauder's decision to walk away from acquisition talks with Puig has been rewarded with a near double-digit share price move, as investors welcome management focusing on its ongoing turnaround rather than adding deal complexity. In technology and adjacent sectors, dispersion is just as stark. Workday has eased fears about AI disruption by posting better-than-expected earnings, raising its margin outlook, and highlighting continued reliance from major AI players, sending its shares sharply higher. Intuit, by contrast, has seen its stock hit hard after a slowdown in TurboTax growth and announced layoffs, underscoring how unforgiving the market is toward any hint of decelerating software demand. Axon stands out as another example. Despite being grouped with weaker SaaS peers, it is growing revenue around 30%, has booked close to $1 billion in AI-related products in its first year, and is seeing institutional investors add on weakness. Elsewhere, Alcoa has benefited from an upgrade tied to expectations of tighter aluminum supply due to Middle East smelter outages. Texas Instruments is rallying on data center demand for power chips, and IMAX is exploring strategic options amid debate about its true franchise value and potential antitrust hurdles. Together, these bottom-up stories highlight how energy exposure, AI leverage, and balance sheet quality are increasingly driving idiosyncratic equity performance. Pulling this together, equities are balancing a deteriorating macro backdrop against a very powerful but narrow earnings engine. An impaired Strait of Hormuz, re-accelerating core inflation, and higher-for-longer bond yields all point toward rising stagflation risk and greater pressure on policymakers, even as the Federal Reserve signals caution rather than an imminent pivot. At the same time, tech and AI-linked profits, data center capex, and upcoming mega IPOs are providing substantial support for index levels, but with growing concentration, governance, and liquidity questions. Consumer and regional data reinforce the idea of a split world. Affluent households and AI infrastructure winners continue to spend and invest, while lower-income consumers, energy importers, and parts of Europe and emerging markets feel mounting stress. From here, the key signals to watch include the path of Middle East energy flows, core inflation and inflation expectations, the tone of Fed communication under incoming leadership, revisions to earnings in energy-sensitive and consumer sectors, and how public markets absorb the coming wave of AI-related issuance. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.